you said it's easy to trigger the rally,
Mm-hmm.
but what would be the real reason that the confidence level that's been raised to actually trigger the rally?
Yeah, I think maybe I should say it doesn't take too much to really to trigger a rally because the conditions are there.
Hi, welcome to the Curious Investor, the show where we break down complex financial topics and help you to make informed investment decisions. I'm here with Redmond, our strategist, and today we'll be talking about what to look for in China this Q4.
Thank you, Lana. Thank you for having me again to the show. Yeah.
Redmond, China's Q3 GDP grew 4.9%, and for the first three quarters, the GDP grew 5.2%. And the National Bureau of Statistics saying that they are quite confident that the whole year GDP target 5% will be reached, since it only takes 4.4% for the Q4, right? So in this situation, why is Chinese stock still falling?
Yeah, I mean the GDP growth in Q3 it was actually quite decent. If I think the number you just mentioned is more year-on-year number, but I mean the China report the GDP growth on year-on-year basis. But if just compare with how this number presented in the US, for example, if you look at the quarterly number and annualized the seasonal adjusted, that actually gives you a better picture of the momentum from quarter to quarter. And you can see actually for the third quarter, the seasonal adjusted annualized number is 5.3%, the growth. That was quite a decent rebound from that, it's a 3 point something, I think it's a 3.24% in Q2. Yeah, and so, but I think that investors look at the detail of the number and they think that, okay, consumption contribute quite a large chunk of it, I think more over 90% of it, and then the rest is from investment, but the export is a drag, so deducted from it. So the growth driver of export in the past was not there, and then also among the consumption you see, I mean the services or some other goods, autos, and those are strong, but the more traditional, those kind of property sector related like household appliances or furnitures or even I mean, those are actually not doing that well. So investors have some concern about whether the property sector and the export sector, these two historically were the main driver for growth in China. If they are not rebounding, whether that GDP growth going forward can be sustainable into 2024, I think that's one of the concerns. And also recent, is that those headlines about developers default, and also about, for example, S&P Global said quite a number of, 1/5 of the those regional banks are actually have, will be suffer from a big capital hit due to the exposure to the local government financing vehicle exposure. And so they need to raise the capital. So, I mean, those concern about local government debt, concern about property sectors continue to weigh on sentiment. And on top of that, of course, you also have higher US interest rate that also has been affecting the sentiment. So I think, the market was, it's a little bit more sluggish than what we anticipated earlier.
Other than economic data, there are also some measures that are seemingly aimed to boost our investors' confidence. Central Huijin recently increased its stake for the 4 top state-owned banks, and the banks rallied for only one day and then gave back their gains. In this scenario, do you still hold on to the tactical rally of Chinese stocks?
Yes, I think so. We still think that the tactical rally will come, and I think maybe we can recap some of our reasoning for why we are calling for that rally. I mean, number one is we are looking for a cyclical rally in the economy. I mean, we have seen some stabilization, as we just have discussed on the economic data. We see a better GDP number. We have not talked about also the retail sales number, also pretty good, and also industrial production also rebound, and so all better than expected. So the number are stabilizing. Yeah, that's number one. And number two is we think that is the analyst, since over the last 2-3 months actually have been revising down their earning forecast on Chinese company quite aggressively. So the bar is actually quite low, and now we have the third quarter number coming up, and so it's not too difficult for the companies, to beat earning forecast. I mean, beating earning forecast, of course, is good for stock price, but not always. But I think we have to talk about the third point is because this is maybe some positive surprise on the earnings. We're actually at the back of a quite rather low valuation. So we have some positive surprise earning, probably. I mean, of course, we cannot guarantee. And then you have a relatively undemanding valuation, and then that, of course, gives some room for better performance for the stock market. And also the position, we talked about that quite a few times already, but just to recap some of the numbers, like, for example, the global mutual fund industries in aggregate, I mean, it's now, I think, the allocation to China and including Hong Kong is about just 6.8%. And then at the top, when they're at the top, in fact, in 2020, you're talking about 15%. So that now you are less than half. And if although long-only global mutual fund, you are talking about is 1.4%. Back in 2020, at the top is 5%. And for the emerging market fund, and it's down, I think, from 37% down to now 26%, more or less. And for the Asian fund, Asian equity fund, and the allocation to China is down to 40% to about 27%. So, I mean, many fund managers, institutional investors are underweight in China. So, and given so the bar is low for earnings surprise, positive surprise, valuation is low, position is light. So the economy is stabilizing. We are not calling for a sharp rebound, but it's recovering. So that's why I think that it's not difficult to trigger a squeeze. And when the price momentum come in, then we draw in more demand. So that's I think we may be able to see a double-digit kind of rally from here. But of course, this is what we think, and but it's not investment advice. I mean, we're just sharing some of our ideas, our observation, and that depends on many other things. We still need to monitor. Investors need to monitor the development very closely.
You said it's easy to trigger the rally, but what would be the real reason that the confidence level that's been raised to actually trigger the rally?
Yeah, I think maybe I should say it doesn't take too much to trigger a rally because the conditions are there, but we need a cause, some kind of a causal event to trigger it to happen. But that can be a much bigger upside surprise in economic data, very good earnings, for example, in the third quarter in some of the major company, and that will also can be the trigger event. And also, there's one thing I want to mention is that there are actually quite a number of important meetings coming up in China, and any news coming out from those meetings or any in anticipation of some some policy from those meetings can also trigger some decent rally.
Can you tell us more about all these meetings that you mentioned?
Yeah, I think there are three rather important, and the number one is the third plenary session of the 20th Central Committee of the Communist Party of China. And why I think that is important because since the economic reform and opening of China in 1978, that's the 11th. That's the third plenary session of the 11th Central Committee. And so the third plenary session is very important because every time when they have a new Central Committee, the first two will be more on organization and personnel. And the third one, usually towards the end of the year or early next year, and of the new, committee, and that will be addressing the economic issues. And usually they are addressing that over the 5-year term for the central committee. So they are looking ahead for 5-year or even 10-year, the development strategies, economic development strategies for China. So of course, in the 1978, we know that that's the opening of China, economic reform, and then the last one is more on personnel, but the one in 2013 is also very important. But we can go into that later on. And then the second important meeting will be the National Financial Work Conference. I think this is the 6th one. And that was supposed to be held every 5 years, and actually should be last year. That should be one. But because of the pandemic, somehow was postponed. So it's very likely that will be taking place in the 4th quarter. And the importance of it is it usually address some of those key issues, critical issues in the financial systems. And now, of course, we just talked about the property sector developer debt, right? The shadow banking or the local government debt issues. They are all actually the domain will be discussed. The topics will be discussed in the National Financial Work Conference. And then the third one is that is usually at the annual meeting in December. That's the Central Economic Work Conference. That's actually reviewing the economic performance of this year and then planning for next year. So you have a very long-term structural meeting for the third plenary session, and then you have one focusing on the financial system. That's also every 5 years. And then you have the annual economic work conference. So that, I mean, given the headwind now the Chinese economy is facing, we are expecting there may be some inflection point. They're making some rather drastic or important changes or new initiatives. So that's why I think that is important meeting. It's not that they will launch those kind of huge fiscal policy or monetary policy. That should be more structural from this meeting.
What should the investors expect from all these 3 meetings?
It's of course it's only we can only guess at the moment, and I think I think for this National Financial Work Conference, I think as I mentioned before, we should be expecting some of the issues to give us better ideas how they address the property developer debt and also the local government debt issues. And that I think that was important because there's a lot of uncertainty in that these 2 particular issues. And then on the very important third plenary section, we don't know whether it's going to be held this quarter, but it's most likely they will do that. And that is, of course, very important. I think is that we set the strategic direction. And so earlier I mentioned about the 2013 meeting. So I don't think, I'm not saying that we should definitely expect that is going to happen, but there is a possibility that given the difficult, it's a headwind the Chinese economy is facing, that it may be some chance that the current leadership will go back to the 2013 playbook. And why is it important? Because it's that back in 2013 is actually they from that meeting, that's a decision that actually is putting the market as the decisive, taking up the decisive role in resource allocation. And on top of that, there's also there are a lot of emphasis on private business development and private enterprises and private property rights, and also limiting the balancing the power between the government and the public sectors and the private sector. So actually, that's quite a lot of things. We still think that is quite relevant to the current issues the Chinese economy is facing. So they actually provide some solution if they can go back to that playbook.
So to sum up, the conditions for a tactical rally is in place, and it won't take much to trigger in this Q4. And for the upcoming 2024, we still need to see what will be coming out from all these 3 meetings. Redmond, do you have anything else to add?
I think, yeah, just one last thing. It means back to the 2013 meeting. Remember, 2013 was actually the first year when President Xi came to power to really heading up the country. So that's not something new to him, but just that is something for other, because he has so many other considerations. So many of those guidelines or initiative or decisions from that meeting back in 2013 have not been implemented. And so that is, we are not saying that it will definitely happen, but there's still possibility that if he can return to pass some of those somewhat, and that would be good for the enhancement of the productivity, better resource allocation in China, that actually can raise the trend growth, that can make us to feel a little bit more optimistic about the Chinese economy and the stock market over the next 2-3 years. Otherwise, it's after that technical rebound, 2024 will still be rather difficult and bumpy.
So stay tuned for more videos on the Curious Investor.
Thank you.
Thank you.